The global economy, it is caught in the grip of Europe's debt crisis. Let's ask our next guest what it's going to take to break free of Europe's problems, decoupling perhaps. Jay Pelosky consults on global asset allocation and strategy for J2Z Advisory. He's a former Morgan Stanley managing director. He's also long treasuries. Mark Lehmann is the president and director of equities at JMP Securities. Mark was a managing director at U.S. Bancorp Piper Jaffray prior to joining JMP. Gentlemen, good to have you with us. All right, Jay, let's start with you because I just noted last time you were on the program, you were saying go out and buy the 30-year treasury. And this was when I think it was around 3%.
Around 330.
And around 330. And I would bet maybe some people looked at you and went, no, wait a minute. Who's going to buy a 30-year obligation for 330? 2.77 today. You made a lot of money.
Well, I think there's been good money made there, and I think there's going to be continued good money made there, and we're probably going to see at least a test of the lows of December '08, which was, I think, 2.5% for the 30-year, and I believe there's a good chance that it's going to go lower than that.
Why?
Well, I think there's been a lot of bad news, and a lot of it's in the price, but I think we've got three main risks that still have yet to be resolved. First is Europe, which we've discussed a little bit. Second is earnings, where we just touched on. And third is stagflation risk in emerging economies. I think we've got to see some clarity on those three things before you can say you can go out and buy stocks. I think stocks are probably going to go down. We've been in kind of like a step-down market. 1350, 1250, 1150. We broke an important level today at 1120.
1120, right?
And we're going to go, I think, to 1050 and then probably to 950 because, as your colleague was saying earlier, earnings have got to come down. Earnings estimates are still projecting 10% earnings growth for next year. That's not going to happen. You've got to flip that and say earnings are probably going to fall 10%. And then you get like an $85 earnings number for next year. You put an 11 multiple on that, and you get somewhere in that 950 to 1050 range.
All right, Mark Lehmann, come in on this topic. Do you think that equities are going to have to be repriced in light of the global economy?
I think they're being repriced, and I think they're being repriced every day. I think as time has gone on and the lack of consensus on how to fix the problems globally becomes more common. And again, as we don't fix things, people sell equities because they see no confidence that things are going to get better. And that's what we're seeing every day. And again, as your guest said, we're seeing lower lows, and that's, I think, a function of the lack of consensus.
All right, Jay. What do you do with your money right now? You want to look ahead to the spring because there are a lot of debt repayments that have to be made in Europe, bank and sovereign debt. But what do you do between now and next spring?
Well, Pimm, as we were saying at the break, every sale has been a good sale for an equity investor, right? If you sold at 1,300, 1,200, and I think if you sell at 1,100, it's probably still going to be a good sale. So capital preservation trumps capital appreciation for now until the end of the year. Coming into 2012, cash doesn't yield anything, and investors are going to have to start searching for returns. And I think the big theme next year is going to be the global search for yield. And I do think there are several opportunities out there. Emerging market dollar-denominated debt would be one. Infrastructure investments would be two. High yield and floating rate debt here in the U.S. would be three. And then four is my old favorite, the U.S. Treasury bond, particularly the 30-year.
You're holding on to your U.S. Treasuries right now, not selling any.
I took profits, half my profits, about a week and a half ago when it got to 122 on TLT, which is the way I expressed that.
Right, the exchange-traded fund.
The ETF. And I kept the remainder of my profits in my whole original position. I think it's going to go to 250, which was the low in '08, if not lower. And people forget that in this kind of an environment, safety trumps all. In Europe, coming into the spring, I think, Germany's going to have to make a decision between whether it wants a strong euro, in terms they kick out Greece and Portugal and the others, which will kill their economy, or a weak Bund, when they socialize the losses and folks start to reprice their government debt as being a hybrid between German and EU debt.
Not just exclusively German debt.
And so you can make some money, I think, shorting the Bund at some point here in the next 6 months.
Let me turn to you, Mark Lehmann. Talk, if you can, a little bit about what investors, what their questions are for you and how you're counseling them right now. What do they do for the rest of the year?
You know, we talk to institutional investors at JMP, and they are as confused, I think, and as nervous as everybody else is. I think they have to look out. Obviously, they're paid to invest in stocks, not to invest in cash. I think they're seeing what we all are seeing, which is a slowing economy, if not a no-growth economy, and they see this taking time. This is not going to be one policy or one country or one economy. This is going to take time, and it's going to take multifaceted approaches. We're counseling people to look for the long term. We have a bent on technology and financial technology, and we're looking at companies that are still growing despite the tough overall economy.
You mentioned companies that are still growing. So what kinds of characteristics do they need to exhibit to get you to buy stocks? Are you talking about things like increasing free cash flow, maybe buying up some of their own shares?
I think it's mostly gaining market share. I think in technology, where we have a big presence at JMP, these are companies who are really changing the face of software. For example, software as a service, changing what used to be the way software sales and back-end maintenance, et cetera, gets done. We're looking for places that are gaining market share and making things more efficient. And that, again, plays in a good economy, less so in a bad economy. But again, over time, that'll gain market share and I think gain market cap.
Jay, it sounds like Mark is talking about a market of stocks as opposed to a stock market, but it seems as though everything is getting hit right now, particularly when it comes to confidence. Talk about the professional investor right now. They must be looking towards the end of the year. They want to try to make their numbers, get their bonus. Is anyone going to make their bonus this year?
I don't think people are, Pimm. I mean, I talk to a lot of folks, as you know, and people are very disheartened. The political risk in particular is really depressing people because they can't model it, they can't protect against it, and it's very hard to profit from it. So very few people have made money, right? Stocks are down, commodities have been killed, real estate has been down.
The only thing that's been good is investing in U.S. Treasuries.
Which no one wanted to do, not even 3 months ago. So no one's made money. I hope Mark is right, because the one thing you need to see for the stock market as a whole to go up is somebody to take leadership, some sector to lead. Technology is an ideal candidate, but it's not doing it, in part because all the money in technology is going into the private market, right? All the social media stuff. The publicly traded technology stocks can't catch a bid. So it's really a hard place to identify leadership. And if you can't identify leadership, you have to be defensive. And so I think a lot of people are really pulling in their horns and thinking and that's going to take the market lower. And then, as I said, it's not that far away. 950 to 1050 is 10% away. And I think that's where you can start to really look to get long.
And in the meantime, just stay in cash a little bit.
In the meantime, I think you can look for yield opportunities, the ones I mentioned. BIP, which is my favorite way to play infrastructure, down 5% today. I think you can look at that. Emerging market debt was down big. There are opportunities out there, but more on the yield side.
I want to thank you very much, Jay Pelosky, Mark Lehmann. Thanks for joining us.